Hi everyone, Wilfred here. I'm recording this while on vacation because, as I always say, the world is my office space. But even though I'm away, I haven't forgotten about you. I wanted to give you a quick update on what's happening in the markets lately. It's been quite an eventful period. Now here's what's going on. The S&P 500 has dropped by more than 9% from its 52-week high. The VIX index, which is a measure of market volatility, has shot up, indicating very high levels of uncertainty. And the Magnificent Seven, which includes some of the biggest tech names, has fallen by a whopping 22% since the start of the year. On top of that, the CNN Fear and Greed Index is now sitting at extreme fear. So yes, the mood out there is really cautious. So what's causing all this fear and volatility? Well, it's mainly due to the recent tariff threats by President Trump. He even proposed tariffs on Canada, which took many by surprise. Although some of these threats were later retracted, they have already created significant uncertainty around global trade policies. And this has unsettled investor confidence. On top of that, analysts have downgraded US GDP growth projections for 2025. The reasons? Mainly the negative impact on tariffs and ongoing political instability. Slower economic growth often leads to weaker corporate earnings, and as a result, analysts have also revised earnings growth estimates for S&P 500 downward. But as I always say, volatility can also bring opportunity. One company I'm recommending right now is Alphabet. Alphabet is a parent company of Google, YouTube, Google Cloud, among others. They are one of the leaders in digital advertising, cloud services, and AI. With their diversified business, Alphabet remains a strong company with long-term growth potential. You can consider buying Alphabet at the market price today. However, if you prefer a bit more caution, you can consider an entry point at $150. Why $150? This is where we see strong Fibonacci support, and from a fundamental point of view, it's a fair value. At $150, we are assuming 9% per annum EPS growth over the next 5 years. This is quite conservative considering that the average analyst expectation is 16% per year. We are also factoring a price multiple contraction to 17 times earnings after 5 years. Just to give you a context, 17 times is the lowest PE ratio Alphabet has ever reached for the past 10 years. Right now, Alphabet is trading at around 20 times earnings. So this provides a decent margin of safety for those who are more conservative and who fear that you could be buying at a peak. So despite all this short-term noise, there are great businesses out there, and Alphabet is definitely one of them. If you got any questions regarding suitability, you know how to reach me so that I can give you financial advice specific to your financial situation. Whether I'm in Singapore or abroad, I'm always just a message away. Take care and talk to you soon.